What really sets successful traders apart? It's a question that many aspiring traders ask themselves as they embark on their journey into the financial markets. Is it innate talent, a stroke of luck, or something more tangible? We often see the glamorous side of trading, the potential for quick profits and financial freedom, but the reality is that consistent success requires a specific set of skills and characteristics. What separates them from those who just get lucky, or worse, consistently lose money? It's easy to attribute success to chance, especially when we see others making seemingly effortless gains. However, relying on luck is a recipe for disaster in the long run. The markets are complex and unpredictable, and while luck can play a role in the short term, it's not a sustainable strategy for building wealth. It's definitely not just luck or some secret foolproof algorithm that guarantees profits. Many beginners fall into the trap of searching for the holy grail of trading, believing that there's a hidden formula or a magical indicator that will unlock instant riches. The truth is that such a thing doesn't exist. While sophisticated algorithms can be helpful tools, they are not a substitute for sound trading principles and a deep understanding of the markets. It's knowledge, discipline, a well-defined strategy, and the ability to adapt to ever-changing market conditions. Successful traders are constantly learning and refining their skills. They understand that the markets are dynamic and that what worked yesterday may not work today. And of course, a clear, repeatable process. This process includes everything from market analysis and trade selection to risk management and trade execution. It's a system that they've developed and refined over time, and it provides them with a framework for making consistent, informed decisions. The tools to trade are more accessible than ever, with countless platforms and resources available at our fingertips. But that doesn't make trading easy or guarantee success. In fact, the abundance of information and tools can be overwhelming for beginners, leading to confusion and poor decision-making. In fact, this illusion of simplicity, often presented by user-friendly interfaces and readily available information, is precisely where most beginners stumble and ultimately fail. They underestimate the complexity of the markets and overestimate their own abilities, leading to costly mistakes. Real success comes from mastering the fundamentals of market analysis, understanding economic indicators, and developing a solid trading plan. It's about understanding risk and implementing strategies to protect your capital. It's about managing emotions and avoiding impulsive decisions driven by fear or greed. And it's about committing to continuous learning, staying up to date with market trends, and adapting your strategies as needed. The best traders treat trading like a serious business, with a well-defined plan, clear goals, and a disciplined approach. They don't approach it as a game of chance or a form of entertainment. In this video, we'll break down the key elements that separate successful traders from the rest. We'll explore the core principles, effective strategies, and essential mindsets that are crucial for long-term success in the markets. We'll also highlight common pitfalls to avoid, helping you steer clear of the mistakes that often derail aspiring traders. Our goal is to equip you with the knowledge and tools you need to start your trading journey the right way, with a solid foundation and a clear understanding of what it takes to succeed. By the end of this video, you'll have a clear, actionable roadmap to guide your trading efforts. This roadmap will enable you to build a strong trading foundation, setting you up for consistent profitability and long-term success in the financial markets. Trading is simply buying and selling financial assets to profit from price changes, whether that's stocks, currencies, or crypto. Unlike long-term investing, traders focus on short-term price moves, aiming to profit from both rising and falling markets. Today, anyone can trade with just a smartphone and a small amount of capital, but the low barrier to entry means it's easy to lose money if you're unprepared. Traders use strategies like going long or short, depending on whether they expect prices to rise or fall. The key is active analysis, quick decisions, and disciplined execution, not chasing get-rich-quick schemes. Successful trading is a skill built through study and practice, not luck. It's hands-on, demanding, and requires your full attention. You wouldn't fly a plane without training, so don't trade without education. The biggest mistake new traders make is skipping the learning phase and jumping straight into live markets. Start by learning the basics: key terms, order types, and the difference between technical and fundamental analysis. Use reputable resources and take notes. Don't just watch videos passively. Practice in a demo account to test strategies and get comfortable with your platform, all without risking real money. Spend weeks or months in this phase until you're consistently profitable in simulation. If you can't win in a demo, you're not ready for real money. This practice is the bridge between knowledge and real-world skill. Technical analysis is about reading price charts to predict future moves. Traders use candlestick charts to spot trends, support and resistance, and entry or exit points. Key indicators like moving averages, RSI, and Bollinger Bands help confirm signals and filter out noise. The goal is to make objective, data-driven decisions, not emotional guesses. Technical analysis isn't foolproof, it's about probabilities, not certainties. Patterns can fail and indicators can mislead, so always use them as part of a broader plan. Many traders combine technicals for timing with fundamentals for quality. Master a few tools deeply, rather than cluttering your charts with dozens. Fundamental analysis digs into the why behind price moves. For stocks, this means analyzing financial statements, management, and industry trends to find undervalued or overvalued companies. In Forex, it's about macroeconomic data, interest rates, inflation, and GDP. Commodities traders look at supply, demand, and global events. The strength of this approach is conviction. You know why you're in a trade. It's best for longer-term trades as fundamentals take time to play out. But markets can stay irrational, and news is released on a schedule, so it's less useful for day trading. Many traders use fundamentals to pick assets and technicals to time trades. Momentum trading is about riding strong trends, identifying those assets that are already moving with significant force and capitalizing on their upward or downward trajectory. It's about recognizing the power of the herd and positioning yourself to benefit from the continued movement in a particular direction. Jumping into assets making big moves on high volume. This means looking for stocks or other assets that are experiencing a surge in trading activity, indicating strong interest and conviction from other traders. High volume often confirms the strength of a trend, suggesting that the move is likely to continue. The upside? Fast profits if you catch the wave. When a stock is trending strongly, the potential for quick gains can be substantial. Momentum traders aim to capture a portion of that rapid price movement, generating profits in a relatively short period. The downside? Trends can reverse instantly, catching traders off guard and leading to unexpected losses. What goes up can just as easily come down, and momentum can shift rapidly due to news events, market sentiment changes, or simply profit-taking by other traders, turning winners into losers. A profitable trade can quickly turn sour if the trend reverses unexpectedly, wiping out gains and potentially leading to significant losses if stop-loss orders are not in place or are set too wide. This style demands constant attention, requiring traders to monitor price movements and volume closely throughout the trading day. You need to be glued to your screens, ready to react at a moment's notice. Quick execution and nerves of steel. Hesitation can be costly in momentum trading. You need to be able to make split-second decisions and execute trades without letting emotions cloud your judgment. The pressure can be intense, and not everyone is suited for this fast-paced environment. Scalping takes it further. It's an even more intense and rapid-fire approach to trading. Dozens or hundreds of tiny trades, executed within minutes or even seconds, aiming for small gains that add up. Scalpers are not looking for home runs, they're content with consistently hitting singles and doubles, accumulating profits over time through a high volume of trades. Scalpers use the shortest time frames, often relying on 1-minute or even tick charts to identify fleeting opportunities, and need ultra-low fees and lightning-fast platforms. Every fraction of a second counts, and even small transaction costs can eat into profits when you're making so many trades. The advantage is less exposure to big market moves, since positions are held for such a short period. But the stress and transaction costs are high. The constant pressure to make quick decisions and the cumulative effect of trading fees can take a toll. Both strategies are advanced and risky, requiring a deep understanding of market dynamics, technical analysis, and risk management. Best left until you've mastered the basics. Before attempting momentum trading or scalping, it's crucial to have a solid foundation in fundamental and technical analysis, as well as a well-defined trading plan and risk management strategy. For most beginners, slower, more methodical approaches are safer. Strategies like swing trading or position trading, which involve holding positions for days, weeks, or even months, allow for more time to analyze market trends and make informed decisions. Know your limits before diving into high-frequency trading. Assess your risk tolerance, trading experience, and available capital before considering these advanced strategies. Start small, practice with a demo account, and gradually increase your position size as you gain confidence and experience. Swing trading strikes a balance between day trading and long-term investing. You hold trades for days or weeks, aiming to capture the meat of a price move. It's accessible for people with full-time jobs, since you don't need to watch the market all day. The slower pace means less stress and lower transaction costs. Risks include overnight gaps and tying up capital for longer periods. Success requires a solid method for spotting trends and timing entries and exits. Most swing traders use technical analysis with a touch of fundamentals for context. For many, it's the most manageable way to trade actively. Trading technology has revolutionized the game. Modern platforms offer powerful tools, real-time data, and advanced order types to everyone. High-quality charting news feeds and risk management features are now standard. There's a wealth of educational content online, but always vet your sources. Automated tools like stop losses and trailing stops help enforce discipline and protect your capital. But easy access can encourage reckless behavior. Don't let gamified apps trick you into risky trades. Remember, behind every slick interface is real money at stake. Use technology to your advantage, but never trade without a plan. Discipline and education matter more than any app or tool. Crypto trading brings extreme volatility. Huge gains and losses can happen in hours. The potential for fast profits is real, but so is the risk of losing everything. Crypto markets are less regulated, prone to manipulation, and driven by hype as much as fundamentals. Never invest more than you can afford to lose and use stop losses. But know that wild swings can sometimes bypass your safety nets. Diversification helps, but spreading across speculative coins isn't true protection. The crypto landscape changes fast. Continuous learning is essential. Base your trades on solid analysis, not hype or FOMO. Treat crypto as the riskiest part of your portfolio, with strict risk controls. Alright, let's take a moment to recap everything we've covered. We've journeyed through a wealth of information, strategies, and insights designed to equip you with the tools you need to navigate the world of trading. Before you embark on your trading journey, it's crucial to consolidate your understanding and reinforce the key concepts. At the heart of trading success lie three fundamental pillars. These aren't just suggestions. They're the bedrock upon which sustainable and profitable trading is built. Neglecting any one of these pillars can significantly undermine your efforts, so let's revisit each one in detail. First, education and practice, the cornerstone of any successful trading endeavor. You need to learn the fundamentals. This means understanding market dynamics, technical analysis, and the various factors that influence price movements. Don't underestimate the importance of a solid theoretical foundation. Then, and this is crucial, prove your skills in a demo account. A demo account provides a risk-free environment to apply what you've learned, test your strategies, and refine your decision-making process without putting your capital at risk. Only after consistently demonstrating profitability in a demo environment should you consider risking real money. This step is about validating your skills and building confidence. Second, choose a strategy. Select a trading strategy that fits your personality and lifestyle, your risk tolerance, time commitment, and financial goals. Don't force yourself into a style that doesn't suit you. Trying to trade in a way that feels unnatural or uncomfortable will likely lead to frustration and poor decision-making. Third, and perhaps most importantly, manage your risk above all else. This is non-negotiable. Never risk more than 1 to 2% per trade. This is a guideline to protect your capital and prevent significant losses from derailing your progress. Always use stop losses. Stop loss orders are your safety net, automatically exiting a trade when it reaches a predetermined loss level, and crucially, never trade money you can't afford to lose. Trading with funds that are essential for your daily life or financial security is a recipe for disaster. Protect your capital first. It's your most valuable asset in the trading world. Profits come second. Focus on preserving your capital and managing risk effectively, and profits will naturally follow. The market will always offer new opportunities, so don't feel pressured to take every trade that comes your way, but only if you stay in the game. Consistent application of these principles is what allows you to stay in the game. Master these principles, internalize them, and make them an integral part of your trading routine. And you'll have the foundation for long-term trading success. It's a marathon, not a sprint. Trading isn't easy. It demands dedication, perseverance, and a willingness to learn from your mistakes. But with discipline and the right mindset, a resilient attitude, and a commitment to continuous improvement, it's possible to achieve your financial goals. Start smart, stay focused on your goals, and never stop learning. The market is constantly evolving, so continuous education is key to staying ahead of the curve. Thank you for watching, and always remember this: learn and grow rich.